Good morning, students. I am R. Punniyaseelan, Assistant Professor, Department of Commerce, Bank Management, St. Joseph College of Arts and Science, Autonomous, Kadalur 1. I am going to discuss with you about the accounting ratio and its types. See the example. There are two companies, A and B. A company earn 50,000 rupees as profit. B company also earns 50,000 rupees as profit. Would you say which company is best? You cannot, because there is no comparative data. Both when you take the real absolute value, both the companies are good. But when you compare with another one data, accounting data, it will reveal some information for making judgments. Say for example, A company's capital is 50,000, B company capital is 1 lakh. A company capital is 50,000, B company capital is 1 lakh. See that the A company is the best. It earns 100%. So comparing with two accounting data, you can make the rational judgment about the performance of the industry. So the ratio analysis is a quantitative method of gaining insight into the company's liquidity, operational efficiency, profitability by studying the financial statements like balance sheet and P&L accounts. So the ratio analysis is a fundamental equity analysis. It is alternative name. The investor and the loan giving institutions wants to know the financial health of the companies. By studying the past balance sheet and income statements, comparing these two statements, comparing with 1 year with another year, it will get some idea about the financial strength of the institution. So it is a measure. Ratio analysis is one of the measure to analyze the financial strength of the company. So based on the past performance, we will also forecast the future performance. So comparing the company's financial standing with the industrial average, this also helps the company to moving forward. So the ratio analysis has different dimension. So the first one is the types of first type of ratio is liquidity ratio. Liquidity means repaying capacity of the company on its current liabilities. So it takes money, it convert the cash or convert into money the current assets and repay the current liabilities. So within this domain, there are three ratios. One is a current ratio, quick ratio and working capital ratio. These three ratios helps to understand the liquidity capacity of the company. Then solvency ratio. The company borrow long-term loans. Whether the company has the capacity to repay the principal amount and the interest amount in due time. So the company's long solvency ratio helps to understand the performance related with long-term borrowing. So this domain ratio, under this ratio, the debt equity ratio, debt asset ratio and the interest coverage ratio and capital gearing ratio, fixed assets ratio also help you to understand the long-term repaying capacity of the company. Next one is the profitability ratio. Every business is meant for earning profit. How much and how well the company generate profit from its operations. The profit to assets, the profit on equity, the profit earned by using the capital employed against the capital employed, and the gross margin ratios are all examples, are all the measurable ratio for profitability capacity of the company. The another three ratios are there. That is the efficiency ratio. The efficiency of using the fixed assets and using the long-term liabilities in order to maximize the profits. Under this efficiency ratio, the turnover ratio, that is inventory turnover ratio, debtor turnover ratio, and creditor turnover ratio, working capital turnover ratio, fixed assets turnover ratio are all help you to understand the efficiency, how well the company convert assets into and maximize the profits. Another one is coverage ratio. That is, it helps you to measure the company's ability to make interest payment, whether it is long term or short term. How much capable the company is to pay the interest amount. Here, under this ratio, the time interest earned ratio and debt service coverage ratio and the interest coverage ratio are all the important tools, important ratios to measure the ability to pay the interest, and the ratio which are related with the stock market, it is related with the investments. So the most commonly used fundamental equity ratio is market prospect ratios. It includes the dividend yield ratio, price earning ratio, earning per share, and dividend payout ratio. All these ratios are calculated by or computed and estimated by the investor. Those are going to invest their money in the companies. So they predict the future earning of the company. They predict the future performance of the company. Based on their prediction, they are ready to invest their money. So all the six ratios are very, very helpful in the view of the financial institution, in the way of management, in the view of the investors. So these ratios helps the company to perform, to understand the level of performance. So with this, I conclude that the ratios are important tool to measure the efficiency of the business. Thank you. We see you in the next class.